All right, you beautiful humans, I have to start out by saying that this video is not about politics. It's about understanding how big decisions in Washington and on Wall Street affect your everyday life, whether you're a consumer, an investor, or a business owner. And right now, there is tension between Trump and the Federal Reserve. And the issue, of course, is the interest rates and how long they're actually going to stay as high as they are now. So let's break it all down, what's happening, why it matters, and how it could affect your money. Now, of course, I think many of us understand that the Fed's big decision recently, just a few days ago, that the Federal Open Market Committee, the part of the Fed that sets those interest rates, well, they voted unanimously to leave the federal funds rate unchanged at 4.25% to 4.5%. And this actually marks that third straight meeting without a rate cut. And why? Well, because inflation is still too high. The Feds prefer the inflation measure, the PCE price index, which is the personal consumption expenditures, and that is actually hovering at around 2.6%, and their target is 2%, so we're just not there yet. Now, the PCE index, it's just a way that the government measures how much prices are going up for the things that people usually buy, like food, clothes, and gas, and lowering those rates too soon could actually lead to more spending and more inflation. And the Fed is just holding steady to avoid making that mistake. And why Trump would want rate cuts? Well, Trump wants the Fed to lower the rates quickly. And if we look at it politically and just briefly here, lowering rates boosts the economy. That looks good when you have the presence of what's appearing like a healthy economy on paper, or rather more like on credit. But economically, lower rates encourage people to spend and borrow, helping that growth. But the Fed operates independently, and Chair Jerome Powell and the FOMC, they're not budging. They're focused on inflation control and not how it makes the current administration looks. And regardless of who you vote for, it's really in the best interest for us that these two entities are separate. As much as I would love to have lower interest rates, I also know that this could potentially reignite inflation. And the disagreement is creating that real friction. And even the talk that Trump might replace Powell basically have given the chance. But to understand a little bit of this, let's actually go back to that situation back in 2020. I know, just briefly here, when the pandemic hit. Now, the economy was in panic mode, so the Fed took action. They bought trillions of dollars in government and mortgage bonds. This put money into the financial systems to keep banks lending and that credit flowing. This is actually what's called quantitative easing. It helps stimulate the economy when things are slowing down. And just so that you know what a bond is like an IOU. So when the government or a company needs money, they sell bonds. So when you buy a bond, you're lending them money. And then later, they pay you back plus a little extra through interest that earns or whatever the terms are. So in simple terms, a bond is pretty much a loan and you're the lender. But by buying these bonds, the Fed gave banks tons of cash to lend, and at the same time, interest rates that were pretty much near zero. Now, you go ahead and add on that $800 billion in stimulus checks and another $800 billion in PPP loans for businesses, and that is how we ended up with a lot of cash just flowing through the economy. Then, of course, by 2022, 2023, we saw the result of the highest inflation in 40 years. So the Fed responded with the opposite of quantitative easing, and it started quantitative tightening. So basically, they stopped buying bonds. They began letting those old bonds just roll off their balance sheets, and they raised interest rates to slow down that spending. And in simple terms, the Fed is now still trying to pull back the extra money it pushed into the system during that crisis. And when the Fed says that they're reducing their bond holdings, that's what they mean by letting those IOUs expire without replacing them. Now, of course, let's throw tariffs in the mix. So it's been an on again and off again situation, and even as of today. So even though there are supposed negotiations happening, the uncertainty is still making consumers and businesses uneasy. And here's the thing, even if tariffs are off the table as of right now, just the talk of them, just these discussions or the lack thereof are already affecting the market. That is a form of market manipulation in itself. And as of this recording, the stock market thinks it is very favorable, but that's just for now. And I am not telling you what to do here, but if you need to make a big purchase right now, it might be a smart move to just wait. I know that some people are saying, well, I'll buy that new car before tariffs hit to lock in a better price. And maybe that works out for you. But I'm also seeing something else where businesses are using tariffs as an excuse to raise prices on existing inventory. And even if those products weren't even affected, they're still happening. Some don't even rely on imported materials, but they're still using this moment to raise prices. And you might say, well, that's actually not good business. But let's be real here. Some companies will squeeze every penny that they can, especially when there are headlines to justify it. And the Fed knows this too. So that's why they pointed to the uncertainty around the tariffs as one of the main reasons that they're keeping interest rates steady. And they're just going to wait to see how this all plays out before making their next move. Although I still don't even think like that next meeting, anything's really going to happen here. So the bottom line though, is that Trump wants those rate cuts now and the Fed wants to wait. And that is the clash. But let's actually talk about this in the sense of your everyday life. So loans are more expensive. The credit cards, the car loans, and the personal loans are all tied to the Fed rate. Higher rates equal higher payments. Now, mortgages, here's the thing, mortgage rates aren't necessarily directly set by the Fed, but they are influenced by it. And higher rates do mean higher monthly payments. It's harder to get into a home or harder to get into the home that you want. Then, of course, spending drops. And when money is more expensive to borrow, people tend to spend less, and that does slow down the economy. I think that's actually what's happening right now. I mean, people are shoring up some of their emergency funds for sure. But the investments, businesses cannot grow as easily, which can hurt the stock market and your 401k and your Roth IRA. But here is a kicker, and that is the job. So when companies spend less, they're actually potentially getting in less revenue, or maybe having to overspend on pulling in inventory before tariffs hit. They may end up hiring less or even laying people off. And that's the thing, they're building their own emergency fund, although many out there might see that as just sort of like stock buybacks and them hoarding money. But let's just think about even the small businesses that do employ maybe some of you out there, just thinking about them where they run very, very lean and do everything that they possibly can to try to keep the lights on and the payroll flowing, but they might not be able to do that in this economy. So that small rate hike might not feel like a big deal, but when rates stay high for a long time, the impact does add up across the whole economy. So really, what is next? So what we're looking at here is higher interest rates staying around a bit longer. And there, of course, uncertainty from tariffs and that global trade, and that's just going to be like the narrative for a while, it seems. But the continued tension between the Fed and the White House. So if inflation picks up again because of the tariffs, the Fed may just continue to delay these cuts even further. But if inflation drops and economic growth slows, the Fed might finally cut, but they're going to move very carefully here because I've seen the likelihood of them continue to not cut at their next meeting, and that just seems to go up and up. But understanding this stuff can help you make smarter money moves, whether you're investing, you're buying a home, or you're just trying to actually keep your budget balanced. But the thing is that just continue to build up those emergency funds. And I am not saying that you have to cut the fun out of your lives. Maybe focus more on experiences, but just have a buffer because this is really going to be quite a ride. Now, if this actually helped make things clear as mud, I would love to hear from you in the comments below. And remember, the best person to take care of your older you is the younger you. And even if you're in your 40s, your 50s, or your 60s, this is still the youngest that you'll ever be today. So start now. You go out there and stay informed and stay empowered on your next level up. And I will catch you right back here on the next one.